Now, again, sort of moving along this, expanding a little more. So now, again, you use the house, let's say, for 2 years or whatever. So basically, you meet the requirements. But then,
you occupy as a principal home.
yeah, principal home for the 2 years, and then you get transferred. So you transfer from Silicon Valley here to Phoenix, and so, but you rent the place out because you're afraid about what's going to happen with prices of California real estate.
And you might come back.
And you might come back.
Right.
Well then, okay, you've been in Phoenix for 2 years, and now you move back to the house in San Jose.
Right.
Now what?
Okay, well that's real easy. There's no discussion of gain because you haven't sold anything.
But what if you sell it then? Okay, now you're down another year. Now you're going to sell the place. Okay,
Right.
let's throw that into the mix.
Okay. So let's say you've lived in it for 2 years. You go to Phoenix for 2 years renting it, and then you move back in for 1 year.
Yes.
Well, and then you sell at that date. So that's April 19th of 2016, just for fun.
Okay.
Just starting today. Well, now you've owned it for 5 years, so that's clearly 2 out of 5 years, and you've occupied it for 3 out of 5 years, so that's clearly 5 years. The trouble comes in when you start doing the math and you stretch this time horizon out. It's only the last 5 years on the date of the sale as a look-back period. So you just have to make sure that when you look back, you have 5 years. Now the 5 years or the 2 years do not have to be consecutive. And I think maybe to your point, if I have a year of occupancy at the tail end and I had a year of occupancy at the beginning of the 5-year period, those are combined to meet the 2-year occupancy requirement.
Okay. Part of what I'm trying to get to is this thing that where in some cases there's a reduction of the exclusion.
Yes.
And maybe you can elaborate on that a little
all right.
bit.
So that's so now you see you have to, for me, you have to talk codes.
Okay.
So that's called 121B5.
Mm-hmm.
You're talking about non-qualified use.
Yes.
Right. So there's, and I'd love to be able to cite this book and verse. I know where to look it up in the code. So this is really, and this gets into a real obscure sort of situation.
Because this is a fairly recent development again.
Correct. For those periods of what's called non-qualified use on or after January 1st of 2009, that's when this rule was made effective, 121B5, the non-qualified use is used in a fraction to reduce the 250 or 500 exclusion. And the numerator is the non-qualified use period, and the denominator is the overall use period. So if you own the property for 7 years and you had 2 years of non-qualified use in there, you would reduce it, the exclusion amount by 28%, which is the 28.6 is that percentage, 2 over 7.
Okay.
Is that what you're getting at?
That's what I'm getting at.
Yeah, right.
So
it's planning, it's care. What are we doing here? You just have to look through the whole fact pattern.
And the problem is that, first of all, most people aren't aware of this sort of stuff.
Correct. And I think you'll hear people in the real estate business giving the general rule.
Yeah.
And sort of, frankly, a little willy-nilly. And then what they should be saying is, here's the general rule, but you should check with someone. You should check with a tax advisor.
Right. And we have a fairly mobile population these days.
Yes.
And again, people, they're concerned, especially we've seen in California. I mean, we can see some big movements in the values of properties.
Mm-hmm.
Unfortunately, we've seen a pretty big one down recently.
Well, no, yeah, but that just means we're on the way up.
Yeah, I hope so.
Yeah.
So anyway, and so again, people in many cases will hang on to their California residence when they leave the area, and they're not aware that this has a tax impact.
Yes, potentially.
Yeah. Now, how about the situation though that now I've been in the home for more than 2 years.
Mm-hmm.
And I just haven't been able to sell the place yet. And I've bought a new home that I'm living in, but I'm sort of hanging on to the other place.
Okay.
So now I'm not able to sell it, let's say, for 2 years, for whatever reason. I have a client that he said, oh yes, my intention was to clean the place up and remodel it before I sell it.
Right,
And then we ran out of time.
I hear you.
So anyway, my point is that included in the period of non-qualified use if you don't move back into the home?
No, the non-qualified use is only before the time when you moved into the home. So the non-qualified use does not include the non-principal residence use after you leave it.
Yes. So this stuff is wild, folks.
Yeah, right. Right.
So knowing, what to do, and so again, we want you to be aware that there are issues with this, and so when you're in a sale of residence mode, or even about this planning again, if you're going to move out and move back in, you better talk to a tax advisor.
Well, I always say, when people consult with me on these types of, a lot of different kind of issues, I always say to them, okay, and they'll start throwing stuff at me like, this, what about the 2-year rule, what about the 5, what about this, what about that, and I say, look, let's just pretend for a minute all the rules have been abolished and income taxes doesn't apply. Just tell me what you want to do. Tell me what you think is going to happen. Mm-hmm. And then once you get all those propositions out on the table, then you say, okay, well, if you do this, that's a problem. But if you slightly altered this situation, you can avoid the problem by this and this. So that's what I try to encourage clients to think about, is just tell me how you want to live.
So for example, okay, the person that's going to relocate to Arizona for a couple of years and they think he may move back into the home or whatever, probably they would be better off if they sold the home, bought an investment property in California that maybe they might like to live in as a residence later. Then they can get their exclusion.
It's possible. Yeah. The exclusion is available once every 2 years. It's not once in a lifetime anymore.
Right.
You don't have to be 55. It's for any age.
Right.
So it's possible that you can take advantage of an exclusion, buy another property if you're worried about inflation. Now, having said that, just as an aside, if you have a very low property roll value on the old property and you think you might want to move back, well, when you buy this new property, this investment property in your proposal,
you will get a new
you're going to get a higher assessment.
Tax.
So that might be another factor as well.
Yeah, so there's something else. I mean, we have to go beyond income taxes.
Correct. And then, of course, just the transaction costs and so forth. So.
Right. All right. Now, we've got the situation. Either we've got the home office, or maybe it was a rental property before, maybe even a property that exchanged into this place. And so there's some accumulated depreciation that happened with respect to the place.
Right.
How is that accumulated depreciation treated? Does that qualify for the exclusion?
Yeah, so let's use some simple examples here. So let's say you bought a house in 2000, you paid $500,000 for it, and down through the years you've claimed $25,000 in depreciation expense, and then you sell it for $600,000. So the gain, in simple terms, is 600 minus 500 is the economic gain, if you will, and that would be net of the commissions, net of the selling costs. In addition to that, you've got this $25,000 that's said to be recaptured on the sale, and that's gain in effect. It's recaptured because you've taken a deduction and now you're claiming it back. The $25,000 is not eligible for the exclusion, and I think that's your point. That's any depreciation that's occurred on or after May 5th of '97.
And what sort of tax rate is that subject to?
Okay, it's a 25% for federal, and for state it's added as ordinary income, which I think now is going back to 9.3, right? Didn't they?
I haven't heard of them changing
I think
yet.
There's a rollback. It depends on.
You're right. Yeah, it's 9.3 now, and then we'll see. They're trying to get it an increase back up to 9.5.
That would take way more than a half hour to talk about.
All right, now let's say that you had a residence that you bought before August 6, 1977. 1997.
Yes.
Right. And maybe you had a previous residence before that. Now what do we have?
Okay, so that's an interesting question. Gain is sale price minus commissions and selling expenses minus your basis. And there's the difference of gain. It has nothing to do with loan payoff, by the way. That's a big. I don't have any equity, so I must not have any gain. That's not how it works. So ignore the loan payoff. So let's say you bought a house in 1960 for 100. You sold it. You bought another one, and you rolled over, and you're at 120. You did it, and so forth, and so on and so on. And the last house that you bought, let's say in 1990, you paid $300,000 for. And then you sell it in 2008 for $500,000. And you're 2 years. Obviously, you've occupied it for 2 years, and you're married finally jointly. So if you just take those basic facts, 500 versus 300, there's 200 gain. But the big however is that when you started back in 1960, you had gain, gain, gain. Every time you rolled over, all of those gains are in effect accumulated. The 300 is not what it seems. The 300 is minus all the gains avoided in the prior time. So those might be, so your 300 purchase price might be, let's say, 150. So when you take 500 minus 150, the remaining basis, then you get a 350 gain. So part of the aspiration of the rule was going forward after 97, we wouldn't have this massive record keeping problem, because then you could just buy a house and then sell it and compare the two and have a gain and exclude or not exclude. Unfortunately, if you had a home that was subject to an older rollover, you still have to keep all those records.
Right. So a question that I always have to ask is, did you have a residence before this one?
Yes.
And was that your first residence? And what was the deferred gain when you sold that sucker? And can you find the form? You know, any,
right. Yeah, there's an interesting trick on that for anybody that has that kind of a situation. In California, typically the deed has a transfer tax, and you can work backwards to sort of figure out what the prices were. And there's comps, and there's other ways to work around that. But yes, you're right. It's a record-keeping nightmare.
Yeah. Okay, Scott, we're just about out of time, so maybe I'll just let you throw out maybe some words of wisdom related to sale of residence.
Well, you know, it's not common now, but I think as time goes by, as we see people buying these homes at these depressed prices, they're going to have gains. We're going to have inflation. They're printing money like it's going out of style. Properties will go up in value. When financing becomes more readily available, prices will go up. So this is an important factor. Your home's still a great investment, and this exclusion rule is really great. I mean, it can really help out in avoiding taxes.
I've actually written an article. I call it "Is Your Residence the Ultimate Tax Shelter?"
Yes.
And so Congress has given us some significant benefits of home ownership, including that deduction of the home mortgage interest.
Yes.
Deduction for property taxes.
Yes.
And then this exclusion from the gain.
Right.
And this exclusion from the gain, for a lot of people over the years, has been a very big deal.
Yes.
And can be used actually for helping to build wealth. So I think we're about out of time, folks. Again, this is just a starting point. There are tax advisors that are available to help here, and use them. It's can be well worth the investment.
Yeah. Penny wise and pound foolish.
Right. So we'll see you next time on Financial Insider Weekly.